So good afternoon, folks, and welcome to our Kings of Capital call with a very special guest, Dipak Gupta, Joint Managing Director with Kotak Mahindra Bank. We also have the Kings of Capital Fund Manager, Tej Shah, with us. So let me introduce Dipak Gupta. It's not always that we have such stars gracing our conference calls. So Dipak is the Joint Managing Director at Kotak Mahindra Bank. He's been there for 29 years. I think he's worked in virtually every part of the bank. I think in the 12 years I've lived in India, whenever I've thought about Kotak Mahindra Bank, whenever I've thought about discussing a tricky issue in banking, Dipak Gupta has been our go-to man. I think from compliance to risk to the credit committee, all parts of banking, this man is a veteran in. I think of his 35 years in banking, 29 years, Dipak has been at Kotak Mahindra Bank. Prior to that, he was at A.F. Ferguson. Would it be right to say, Dipak, A.F. Ferguson means you are a CA? Right?
I don't claim that fame.
Right.
I am a Bichara MBA.
Acha, you're an MBA.
At one point of time, I used to be an engineer before.
Okay. So engineer come MBA and now a veteran banker and expert on surveilling, understanding the Indian credit landscape. So we will come to Dipak for his thoughts on what he makes of the post-COVID world. Before Dipak gives us his thoughts, I'll request Tej to just set the scene with what's happening in Indian banking. Folks, we will do a Q&A with Dipak. Once Dipak's finished speaking, we'll do a Q&A with him. If you have questions, keep dropping them in the Q&A box. And once Dipak's done speaking, I'll take the questions. We have Dipak till 6 o'clock, so let's make the most of his time until then. So Tej, over to you to kick things off.
Thank you, Saurabh. So we'll start off with a background of why we launched the financial services focused fund Kings of Capital in July last year. What we had seen till then was that the previous 6-7 years, there was a crisis or a challenge every year, especially for the financial services sector. Multiple macro-related challenges which impacted banks and NBFCs largely, whether it be the asset quality review in 2013, 14, 15, whether it be demonetization, introduction of the GST. After that, then there was the ILFS crisis, Yes Bank DHFL crisis, so on and so forth. As a result of that, we saw that NPAs for the sector grew more than twofold. They almost tripled over a period of 5-6 years. And this was even before COVID hit us. It was with this background that India saw COVID come through, and then there was this lockdown for a period of 3-4 months, because of which there was even more pressure, especially on the weaker banks, weaker NBFCs in the ecosystem. However, what we had seen historically was that high quality lenders gain market share post a crisis. So whether it be the global financial crisis, whether it be the crisis of the late 90s, early 2000s, when 70% of India's NBFCs suffered, we saw that it was the high quality banks, high quality NBFCs who had access to liquidity, who had access to deposits, and they were able to absorb NPAs irrespective of the magnitude of the crisis, who were able to gain market share post the crisis. And the reason behind this is that, first of all, high quality lenders would have been prudent in their lending practices even before the crisis hits. Secondly, they have enough strength on the liability side of the balance sheet to not only survive the crisis, but also grow through the crisis and gain market share post the crisis. As and when the credit demand returns, these high quality banks and NBFCs are able to gain market share from the weaker players in the ecosystem. Because most competitors would be struggling with either asset quality issues or struggling to raise deposits in the case of banks, struggling to raise liabilities in the case of NBFCs, the high quality lenders are able to pick and choose the borrowers of their liking. They're able to price the risk according to their liking in the post-crisis era, because of which the net interest margins expand post the crisis, because of which the asset quality and the NPA ratios also start normalizing post the crisis. As things start normalizing in the post-crisis era, we also see that PE multiples normalize. As a result of which, equity shareholders tend to gain disproportionately and also get the advantage, which can be divided into three parts. One is market share gains. Second is asset quality improvement and expansion of NIMs, and third is normalization of PE multiples. What we saw over the past 40 years is that there is a direct correlation between what happens in the US and what happens in India. And I'll hand it over to Saurabh to take you through this slide.
Sure. Thanks, Tej. So, folks, we've seen this repeatedly in the last 45 years. America goes into recession in year T. The dark gray areas are American recession. So, 79 to 82, 1990 to 92, 2000 to 2003, 2008-9, and obviously last year was an American recession. So, you see American recessions in year T. In T+1, the red arrows, India's economy booms, right? Why does that happen? Two very simple reasons. A US recession gives our country the two things we need the most. The first is cheap oil. The gray line, the brown line, I'm sorry. The brown line is the price of oil. When the world's largest consumer of crude goes into recession, the price of oil falls by 50 to 80%. You can see that in 91, you can see that in 2000 to 2002, you can see that in 2008, and obviously you saw that last year. A 50 to 80% drop in the price of oil is a 3% of GDP boost to India. It's like God dropping 3% on our country. And we saw that last year, right? The government kept the pump price of petrol the same, but they loaded it up with tax. It gave them a 3% of GDP fiscal boost, which they used to do the fiscal relief that they announced in August, September last year, right? So simple maths. 50 to 80% drop in the price of oil, we get 3% of GDP boost. The second big benefit we get from a US recession is the blue line, the US 10-year bond yield. Naturally, the US 10-year bond yield drops during a US recession, typically drops by 2.5%. Ironically, last year it dropped exactly by 2.5%. When the US 10-year bond yield drops in a US recession, given that oil is already crushed, the RBI passes on the relief of that drop in the bond yield to all of us through lower interest rates, right? So everybody on the Zoom call, plus our guest banker today, were beneficiaries of this. Cost of funding dropped by 2.5% last year, and as a result, if you drive around the streets of Indian cities, you can see home loans at 6.6%. Prime rated corporates are borrowing money in the Indian bond market at 4.5%, lowest rates in Indian history. So in short, a US recession gives India cheap oil and cheap money. US recession in year T, Indian recovery starts in T+1. It's played out like a clockwork. We were talking about this exactly a year ago in our webinars. Back to you, Tej.
What we discussed in the earlier slide so far was around the lending part of our portfolio. So 60% of our portfolio invests in banks and NBFCs. And therefore, we saw that there was a major crisis over the past 6-7 years. Then there was COVID. And banks and NBFCs, high quality banks and NBFCs gained market share post a crisis. The remaining 35 to 40% of our portfolio is invested in non-lending financials, which is life insurers, general insurers, asset managers, wealth managers, and brokers. Now, what we saw and why we have 35 to 40% of the portfolio in non-lending financials is that India is the only major economy at around $2,000 per capita income, which has only 5% of household savings in financial assets. So if we even don't compare India to US or some of the European countries, even if we look at South Korea or China or Indonesia, all of them have around 30 to 40 to even 50% of household savings in financial assets. Now, if we make a conservative assumption that India goes from 5% in financial assets to even say 15% in financial assets over the next decade, that is about $100 billion shift to financial assets from real assets every year. And this is assuming that India's household wealth does not even increase over the next 10 years. And we believe that this shift from physical assets to financial assets will benefit direct equities, mutual funds, life insurers, general insurers, and of course, money will move to bank deposits. So as a result of which, we believe we've picked the best life insurers, general insurers, asset managers, and brokers in our portfolio who will benefit from this shift towards financial assets over the next decade. Now, the way our Kings of Capital portfolio companies have performed over the past 5 years is that despite what has happened in the macroeconomic environment that we discussed, they've still given out 20 to 21% earnings growth, whether we look at the past 3 years, whether we look at the past 5 years. And this is along with a return on equity of 19 to 20%. There is a big difference between the companies in our portfolio versus even, say, the bank Nifty. So 20% sort of earnings growth over the past 5 years for Kings of Capital companies versus 7% for the bank Nifty, 19% return on equity in FY20, which was a year where most of the lenders took COVID provisioning in the last quarter. Despite that, 19-20% return on equity versus 10% for the bank Nifty. Now coming to the larger question which we are getting most often right now is how have lenders, especially lenders in our portfolio, handled COVID-related stress? Despite the Supreme Court ruling on not recognizing NPAs, most of the banks and NBFCs in our portfolio have provided well for COVID-related stress. The reason that they've been able to do this is the tier 1 ratio for the lenders in our portfolio has actually increased year on year. So the tier 1 in Q3 FY20, this was before COVID, was 17% on average for the lenders in our portfolio versus 20% as we speak today. So despite COVID, there has been an increase by 3% in the tier 1 capital of the lenders of our portfolio. Now, assuming that the complete restructuring book is stressed, assuming that the pro forma gross NPAs will remain as it is, even with these conservative assumptions, the provision coverage ratio for the lenders in our portfolio is more than 100%. So we believe that more than 70-80% of the stress has been provided for. Whatever is the incremental stress will come through maybe in the next couple of quarters. And the impact on profitability going forward will not be much, irrespective of whatever the optical gross NPA numbers will look like because of the Supreme Court ruling. And finally, coming to growth, how do we go forward on growth? How are the lenders positioned in terms of capitalizing on loan demand coming back, macroeconomic recovery, etc.? So even in Q3, that is the quarter ending December, we saw that QOQ growth was for the lenders in our portfolio back at 4-5%. So annualized growth was at 17-18%. We believe that incremental growth will come through because most of the lenders are well positioned, because they have enough tier 1, because they have enough capital, and because they have enough liability strength. So they're well positioned to capitalize on growth as and when the loan demand growth comes through. They'll come back to 18-20% sort of growth which we saw on the earlier slides. So I'll stop here and back to you, Saurabh.
Thanks, Tej. Thank you. So Dipak, we now hand the mic over to you, metaphorically speaking. Would love to hear your thoughts on what you make of this remarkable post-COVID landscape. You guys were I think you fired the starting gun for the market recovery in banking stocks by doing your QIP very early on. I think it was September, perhaps, right?
No, at that time, we thought that you have to survive this pandemic. Yeah. And this pandemic will have a lot of trouble. Yeah. It's like you're at one shore now and you have to go to the other shore and there is a storm brewing. Yeah. And while you're, traversing from this end to the other, because of the storm, a lot of your colleagues around will get into trouble. You have to have sufficient fuel to cross. So the earlier you take the fuel, hopefully the more ammunition you have to reach the other end. But what really happened, as it turned out really, is though we started the whole process, a lot of other people also capitalized. Yeah. So I think it protected the industry per se very significantly in that period of trouble. Yeah, which is what Tej's graphs really showed. And since Tej basically showed two pieces of the marketplace, one is the recovery or the collection piece, and the other really is the growth piece. Let me just probably spend a couple of minutes on these two aspects really. I think when you look at the last 10 months and you go back to the months of April and May last year, it seemed like doomsday, yeah, because the pandemic had moved very, very fast, and there was trouble all over. And at that stage, when all of us reviewed our portfolios, we said this is a long-term trouble. Yeah, we said stage 1, stage 2, stage 3, all of that we said, but all of us thought that it is doomsday. And all of us very aggressively estimated kitna loss hoga har ek area mein, estimated loss, let's provide for it. Yeah, that was our reaction, immediate reaction. As you see the progress over the last 8-10 months, and as you sit today over here, what seems really is it was not as bad as it seemed. And I'm not talking about the second and the nth wave, which is there. But as of now, when you look back, you realize it's not been as bad as it seemed at that point of time. Yeah.
Right.
So probably there was an overreaction, or like all of us say, oh, we were adequately provided. Yeah. But when you get deeper into it, the story is not exactly the same.
Wow.
When you get deeper into it and look at, let's say, the 3 or 4 broad segments of business which a financial entity does. You look at the corporate segment, you look at the SME piece, you look at the agri piece, and you look at the retail piece. And again, retail there is a secured part of retail and an unsecured part of retail. The interesting piece really is, when you look at the corporate part of the lending, yeah, it is nowhere near what we thought it was. All of us, भाई ये corporate चला जाएगा, वो corporate चला जाएगा, इसमें loss हो जाएगा, इसमें provision कर दो. It is practically close to zero. If I look at a 0 to 10 scale on the corporate side, it is practically close to zero. Maybe 1, 2, thereabouts.
In terms of stress.
In terms of stress.
Right.
Now you try and think, why is it like that? And one of the things which comes to mind really, and Tej showed on his chart also, is a lot of corporates were already in trouble, even before. Yeah. So the so-called troubled guys were already out.
Nice point.
So what was left was relatively the less troubled guys. And even within this less troubled guys, yes, the growth curve was a sharp K in any case. But all of them were either reasonably capitalized, or some of the even troubled ones managed to get fresh equity. Even the lower part of K curve guys managed to get fresh equity, infrastructure, real estate, hospitality, a lot of them picked up equity on the way. Really. Or a lot of them, had sufficient liquidity to survive. So the corporate side is close to zero. On the other extreme, you have what I call unsecured retail. Usme, whatever we had thought has happened.
Right.
So it is close to 10.
Wow.
At this stage. Okay.
So 10% of the unsecured book is showing stress.
No, I'm saying the unsecured piece is on a 0 to 10 scale. It's not 10%. It's on a 0 to 10 scale. If we had expected X, today it is X. In corporate, if we had expected X, it is close to 0. Yeah, and the other 2 segments are somewhere in between. So while on an average basis,
yes,
ऐसा लगता है कि भाई it is not as bad, there are nuances to the whole piece. So if I were to sum up on the recovery collection pieces, Tej was right. It isn't looking as bad as what one had thought. And hence, when you look ahead, and by the way, whatever we had thought of in any case is adequately provided. Yeah. So sort of the road ahead seems pretty clean and clear. Yeah. And of course, I'm caveating it by saying, this discounts this second or third wave. Yeah. So don't hold me for that piece. As of now, that's how it is. When you look at the growth part, the growth part has been a mixed bag. Yeah. And the mixed bag with a lot of variations. Yeah. Yes, like I said, it has been a standard K-shaped recovery. The upper part of the K curve is still small. Yeah, there is still a large part of it which is on the lower part of K, which means segments, sectors, industries, individual corporates, which are not out of the woods yet. And when we look at the marketplace, we saw some amount of seesawing happening. Yeah, there is some amount of pent-up demand which comes to the marketplace. Yeah, maybe because of a festival or whatever, some discounts or year-end, and then it vanishes all over again. So the signal on the growth side, at least at this point of time, is still guarded. Yeah, I wouldn't say, it is victory. Yeah, it's not a victory project, sort of. Yeah, it is different. So that's growth, and growth we will have to watch. I can hope for the future to be bright. You speak to anyone and they will come back with a 10, 12% GDP growth rate going forward. But that's from a, negative base rate. Yeah. When you look at, over a 2-year period, you will still not end up with very significant, maybe 1%, 2% on a real term basis. So growth is still caution. Yeah, it is not over the hill, I would say, at this point in time. And within growth, growth normally happens primarily 2 key drivers for growth. Yeah, one is the working capital growth from a banker's perspective. One is the standard working capital growth. The second really is growth arising out of capex. Yeah. The second piece is even more distant. Yeah. And then I'm not counting, let's say, the steel sector or maybe the cement sector, which is doing capex, but those are, the outliers. Really. Yeah, steel has had a phenomenal run. All the money which all of them borrowed in the last 6-7 months, last month aake sab de de, wapas de diya. Yeah, because they're just throwing up so much cash.
Yeah.
So the upper part of K is doing very well, undoubtedly. They're not borrowing. Yeah, they're throwing cash up. Yeah. So that's the dilemma which we have at this point. However, at the macro level, while that is how it is looking, individual entities still have a reasonable smooth sailing. Because when you look at the marketplace, the competitive environment is very different today. Yeah, you take a simple thing like home loans, mortgages. 2 years back, every Tom, Dick, and Harry was out there in the marketplace offering, the lowest to the lowest, rate. And it didn't make sense to do business at those rates. But today it's very different. You have only so many players. Yeah, and the incremental demand in some of these segments has come back with a vengeance. Yeah. So the opportunity basket suddenly looks bigger because there are only so few players out there. And that's why the optimism. And again, when you look at us, about 4 or 5 months back, one of the key calls we took really was, last 8-9 years, we've basically driven the liabilities part of the game. Yeah, the liabilities part of the business, which is savings, deposit, customers. And we basically drove it through a very reasonable savings interest rate. Yeah, and everything we drove around that. Our entire technology spends were largely around customer acquisition for savings products. And that's why today, if you look at us, we probably have the highest CASA ratio in the industry. But what we now see really is, since the competitive environment is very different, and the other interesting piece for us personally is the cost of funds is practically the lowest in the marketplace. And that combination makes it very attractive for segments which are secure, which are sticky from a customer point of view. And now you can have good ROEs in those businesses. So that's the key driver. So a lot of our strategy is, moving from acquiring only savings customer. And customer acquisition still is a key part of our strategy, remember, because at the end of the day, we are still a very small bank in the overall marketplace. to how do I now engage with this customer which is coming. And then when you look ahead, all of this will get driven and is getting driven increasingly through technology. Yeah, because that's just the future. Yeah, all of us are 50% technologists and maybe 30% bankers. Yeah, the other 20% is administrators. So that's so those are my quick
So just to
bits really.
quickly summarize, and folks, keep firing your questions into that Q&A box. We have Deepak until 6 o'clock, so let's make the most of his inputs and his knowledge. After 6 o'clock, you'll still have Tej and me answering questions on the portfolio. So portfolio related questions, baad mein pucho. Let's make the most of Deepak Gupta's time till 6 o'clock. So I'll quickly summarize, Deepak, what you're saying, and then I'll pose the first question. And Tej, if you could just keep curating from the Q&A box for the next few questions. So first point you're saying is the overall stressed asset picture is looking much less worrisome now than it did 6 months ago when you guys did the QIP. But that overall picture of sort of comfort hides a polarization. Jahan pe unsecured retail, there is concern, whereas corporate is sort of sparkling clean, right? It's probably the most positive characterization I've heard on corporate credit for a long time in India.
Yeah.
Right. So, and coming from you, that's high praise for corporate credit quality. Right? Second layer is you're talking about growth, and growth pe aap bol rahe ho, that again, the growth picture perhaps is not as buoyant as perhaps we as investors would like it to be, or perhaps you as a banker would like it to be. But again, the overall picture of less than ideal buoyancy on the asset growth side hides a detail, and the detail is that in several sectors your competition has withered away, right? And specifically we were discussing housing finance. I presume you mean the non-bank part of housing finance, where some of your erstwhile aggressive competitors of 2-3 years ago are not in the framework anymore, which I guess is what explains the Kotak Bank hoardings on the highways of Bombay saying 6% pe up home loan lijiye. You're allying that to your sharp drop in cost of liabilities over the last couple of years, and you're saying you've got the lowest cost liabilities in India, and hence even
amongst the lowest, I would say.
Right. And therefore, even on that 6.6% वाला जो hoarding मैंने Eastern Express Highway पे देखा,
6.65 है, 5 पैसा और घटा दोगे तो ट्रबल हो
ठीक है. So we are shareholders, हमारे लेने के देने पड़ जाएंगे, हम क्यों घटाएंगे सर? So 6.65 पे you can still earn a good spread on that, and you're saying the competition really is not enormous at that 6.65 level, whereas I remember June 2017, there were housing finance companies issuing CPs at 6%, and therefore it made no sense for you. So in that regard, the consolidation of market share in your hands is happening, albeit beneath the waterline, and albeit in retail rather than in corporate. Because हमारा एक साल पहले अगर हम बात करते हैं, उनको लगता था corporate में you will gain share, but ironically through a serendipitous route, retail में you're gaining share.
Yeah. See, corporate में share gain करने का issue for us is slightly different. If you look at us as a bank on the corporate side, we are present practically everywhere where we are comfortable to be present. Yeah. And in all of these places, our exposure currently is where I would say close to what the appetite is. And the question really is, do I increase my appetite in some of these places, given what I look ahead, or no? It's not about acquiring new customers. We are there everywhere. So if you look at corporate A, B, C, D, E, F, G, wherever we want to be there, we are there. So do I want to take 1,000 crores more in corporate A, or am I comfortable by gulab jamun acha hai, pet bhar gaya hai, or risk nahi leni hai?
Right.
That point of view.
So let's sort of begin sort of linking our clients' questions with what you've said so far. So let's start with corporate. Nice place to start. Happy note to start. You're seeing corporate credit quality surpass your expectations. Steel companies, right? Steel companies are coming in, repaying you in 6 months. That is the level of corporate credit quality we're seeing. In the same time, the public sector banks in our country, right? सरकार के पास recap करने के खास पैसे तो है नहीं, so they are maxed out, right? And surely, therefore, the next 2, 3, 4 years is the time for yourself and perhaps a couple of other private sector banks to clean up on the corporate side and build a, say, 3-4 player duopoly construct in corporate lending. Credit quality आप लोगों को अच्छी दिख रही है. You've got tier one. The QIP was beautifully timed. Opposition, PSU bank competition withering on the vine. Isn't this the time to go for it on the corporate side?
Yes, it makes sense, except for two caveats, really. One is, remember, at the higher quality end of the corporate spectrum, no bank will let go, even if it is, within quotes, unprofitable. Yeah, because those are your prized customers. So you don't normally let go very easily. The second issue, of course, is what I call risk appetite. See, at the end of the day, from a banker's perspective, concentration risk is an extremely important risk parameter. And we value that extremely because, you have found over the last 20 years, आज बहुत अच्छा लगता है. In a year's time, things change and they change very fast. So someone or a corporate which looks very nice today may not necessarily be the same, even a year later or 2 years later. And you may end up taking sort of 3-year, 5-year exposures at this point of time. And, corporates themselves have been very smart. Interest rates have come down to, rock bottom. Yeah. So all of them have sort of swapped their older debts with low cost and longer tenures, both ways. So you at this point may run the risk of, lending long, so you are mismatched at one end at a low cost really, and locked in for a longish period of time. But having said that, underlying of what you're saying is right. There will be significant opportunities within the broad framework of concentration appetite.
Okay. Now let's just look at the retail piece, right? So retail lending in India, right? Clearly, over time, the public sector enterprises, whilst they'll probably cling on to the retail books, incremental growth in the PSU's retail books is gonna dwindle, and the question then becomes, if you had to look out, say 5 years out, 10 years out, will we see that housing finance or a LAP or perhaps even unsecured retail, will that become a 3-4 private sector bank dominated sector, or will it stay in the current highly fragmented format where 100 NBFCs are also doing retail, 30 PSUs are also backing it out in retail, and every private sector bank is doing retail? Do you see consolidation in retail coming?
So for retail, the way I'd look at it is I'd broadly break it up into two parts. Yeah, one is what I call secured retail, and the other is what I call unsecured retail. Now, secured retail by nature is safer, yeah, and normally something like a mortgage or so is a pretty sticky product. Customer एक बार आ जाता है, फिर जल्दी, just because तुम्हारा चाराना कम या ज़्यादा है, he will not run away. However, the problem on secured retail, still largely for us really, is it still has a very frictioned process. आपने होम लोन लिया है, आपको रजिस्टर ऑफिस पे जाना पड़ेगा, रजिस्टर करना पड़ेगा. There is a physical element which is not digitizable easily. It will probably happen. It's happening. Parts of it are happening, but it's still not friction free. The unsecured part, on the other hand, is increasingly becoming friction free and digitized. So on the secured side, the competition still will require physical presence advantages. On the unsecured side, it will move to digital, and the competition will not just be banks or financial services firms. It will be the fintechs, it will be the e-com guys, and we have to watch out for all of them really. But on the secured part, it probably will still be restricted amongst banks and some NBFCs.
Right. Tej, over to you.
Yeah. If we were to look at COVID as a crisis, where would you say we are today if you were to compare it to the past 20, 25 years? Is it comparable to, say, the global financial crisis, or would we say we are in, say, 2003-4 sort of mode where we can see a lot of recovery has already come through, and the next 3-4 years we'll see a strong sort of growth coming through? We are already at, on an interest rate from an interest rate perspective, at a low, which is similar to 2002-3. From a recovery perspective, maybe we are where we were in 2009-10. Where would you say we are right now?
Each of them is a different set of circumstances. Yeah. This time round, very different from last few times. Like I said, two things. One is provisioning seems to be reasonably adequate. Yeah. B, unlike the last round, the corporate segment, touch wood, up to now, has been pretty good. If you see trouble and stress, whether it was the 2008-9 time, or you look at the 99-2000 time, or the 2003-2004, stress always came big time from the corporate side. Yeah, and again, I'm saying touch wood, this time round, it doesn't look like that. And B, fortunately, all of us have sort of planned in advance and provided. In the last few rounds, the provisioning and the hits happened later on. Yeah, here all of us, maybe in haste, I don't know, possible, we're sort of pre-prepared. And it wasn't as bad as what we had expected. So it's been different this time round. And hence, if macro growth comes back, I suspect recovery will be much faster. Because, one is you're fighting recovery. B is, I have, accounted for it, it is provided for, let me move ahead with life and get on to growth. So it's more of that kind this time rather than the past. So, the extent of trouble may be relatable to the previous times, but the circumstances gives a far more optimistic proposition at this point.
So there's never a good time for things like COVID to happen. But if you ever said, I can time it as a banker, you would have said, bilkul corporate stress cycle ke bilkul end mein karo.
Ekdam baad mein aaya. And then you see that it's a fortunate timing from that point of view.
Right. So it's actually a very nice insight that COVID could not have been timed better from a corporate stress cycle in our country.
Yeah.
So I've got two related questions actually from different people on your liabilities franchise. Both are sort of grudging admiration wale question. So Narendra Shahji asks, how come Kotak can do these 6% wala SA accounts? Dusre bank to 4 karte hain, 4.5 karte hain. How can Kotak afford to do 6 and still say that our cost of funds is the lowest in the country? So that's one question on the liabilities from Narendra Shahji. Then Hiren Kumar Desai, he says, I'm both a customer and an investor in Kotak. Was it not possible, in brackets, was it not possible for management to get some sense of stress when you raised capital, but at the low price of 1100? So he's saying, jab aapne paisa raise kiya, could you not do some maths and say stress utna bura nahi hai? So one is on the equity side of liability, dusra on the your SA piece. How can you pull off the SA miracle?
So I think the first one is the simple one. Yeah. Ultimately, remember, it is how you look at it. You can say, bhai, mera SA rate 6% hai, kisi aur ka 4% hai. But what happens really is you're growing your deposit base very fast. So the comparison is not with the 4% of someone else. The comparison shifts to incremental money. Is it coming at 6%? Or incremental money I have to borrow in the form of term deposit, is it coming at 7%? So the way you have to look at it is the incremental money is coming at a lower cost. Don't get carried away by just the 6% on SA, because the 6% SA, converts into a CASA of close to 60%. Someone else at a 4% SA may be at a CASA of 40%. So I have a much higher share of low-cost deposits, which means my incremental deposits, which I have to borrow at a higher cost, which are typically term deposits, is that much lesser. Yeah, if you do a simple maths, you will realize that 40% at 4% and the balance 60% at 7%, or 60% at 6%. And by the way, it is not 6 all through. Yeah, 6 is only in the lowest bucket. And the remaining 40% at a higher cost, you will arrive at a simple logic. So we look at it as savings from term deposit, because that is what you are saving when your CASA is so high. It would not be the same if the CASA, our CASA was also at 40%. So we have a much higher percentage of low cost deposits. So we need to borrow lesser of higher cost deposits. That's the way. That's why you can justify 6%. And you know, there is a very interesting phenomenon. And I call it the fight between the heart and the mind. A deposit customer, particularly a savings deposit customer, is what I call a lifetime acquisition. एक बार customer अंदर आता है, then he's comfortable. He's a very, high inertia customer. He will not run away because, liability side of a bank's business is business of the heart. He likes you, he trusts you, he's comfortable with your mobile banking app, he finds it very convenient, all of that. So फिर 4 आना 8 आना के लिए the customer does not move around. The asset customer, someone who takes a personal loan from you or a credit card from you, comes from the mind, or a car loan operates from the mind. He's not coming from the heart. 4 आना कम हुआ, he will shop around, सबसे कम किधर होता है, he will go from there. On the liability side, customers rely a lot more on softer aspects of finance rather than the tough interest aspect. So for example, we don't offer 6 now. We are practically at 375. But it doesn't mean customers have walked away. Yeah. So that's the first one. The second one is a difficult one. You see, at that point of time, when you looked around, like I said, it looked like doomsday. Yeah. And one of the philosophies which we as a firm have always prophesied really is protect capital. Yeah. And be adequately protected. So it is safer for you to run with comfortable capital rather than start running for capital later on. And like I said, one of the big opportunities we saw at that point of time is a ship has to move from this shore to that. And there is a storm. And in this storm, there will be other ships. There are other ships. Some of them will fail. And there will be opportunity for you to acquire them. So be tanked up with capital so that if those opportunities do come, you can, go in for those opportunities. Of course, like I said, after that, everyone started raising capital. So the opportunity basket got limited. So the second one is a position which you take at a point of time based on circumstances. With hindsight, it may look, yes, why did you raise capital at that price? But that's the call at that point of time. You will be right sometime and not necessarily right.
Looking on the bright side, Dipak, one of our mortal fears in Marcellus when we launched the Kings of Capital portfolio was Tej figured out, and he did a lovely chart for our clients that जब भी Kotak Bank का QIP होता है, that's the top of the capital market cycle, right? So we were so glad that you got the QIP out of the way so early in the cycle this time. Tej, over to you.
So one of the questions is related to what we discussed. One of the clients has asked whether, so now that all the large private sector banks have enough capital, enough tier 1, will there be consolidation of banks in the sense of acquisitions? Because the government's also started to show signs of divesting PSU banks. Is there a possibility that say a Kotak or one of the banks acquires one of these banks?
Well, it is a possibility. Yeah. See, ultimately, it's a combination of several factors. Yeah. First, the economics has to be right. Yeah. When I mean economics, really means what are you acquiring at what price? That's extremely important. I think the second thing which people forget, and we've been through it, so I can really comment on it. Fitment is extremely important. Cultural fitment. Yeah. Very, very important. Yeah. Otherwise, you end up wasting 2 to 3 years post combination or merger in just trying to fight that battle, and you lose very critical time in the marketplace. Yeah. And of course, the third one really is at the end of the day, which probably is related to the first one of economics, really, is what are the pluses and what are the minuses? At this stage, when we look at it ourselves, we need a lot of customers because, like I said, we are still a very small bank. So the opportunity for customer acquisition is high. The opportunity for geographical presence is not very high. So you will not be willing to pay too much for geography, but you will be willing to pay significantly for customers. Yeah, and that's what will drive the economics basket. So I wouldn't say it is a clear yes or a clear no. I think it needs to be evaluated, and there will be takers, undoubtedly, of course.
But Deepak, if you leave aside the specifics of whether Kotak buys a PSU bank or not, do you reckon the next 10 years will see further consolidation in the Indian banking sector, or will it see further fragmentation in the Indian banking sector as new guys come in?
I think the fragmentation mix will be different when I look ahead. Okay, it may not necessarily be the same kind of people who you have out there. I think it will probably be a much more very different mix. Yeah. So I suspect fragmentation, but a very different mix.
So I suppose one scenario that we keep thinking of is 4 or 5 giant banks and then a long tail of chota banks, lots of purana private sector banks and so on.
But sort of, what is banking? We are increasingly coming to, that belief. What is banking itself will change. It may not be this way. It may be very different. And this tech world, and then we are very watchful of it really, is a very different ballgame. What a bank of tomorrow will be and look like can be very different from what it is today.
So that's an interesting subject, and that prompts me to ask something. Neither in the Western world nor in, say, places like Singapore, which are fairly high-tech places, nor indeed in China, have we seen tech disrupt banking in the sense of lending money. ठीक है, fintech वगैरह थोड़ा बहुत है, but fintech as a mainstream business activity hasn't yet become prevalent in any economy, including economies far more technologically sophisticated than ours, right? Similarly, barring say Taobao in China, we haven't seen the liability part of banking also being taken up aggressively. So, for example, robo advisories, online asset managers, etc. कुछ खास चला नहीं है, right? So this perpetual notion that banking as we know it could be disrupted by tech. Have you guys seen real sort of cogent, concrete examples of where tech has come and disrupted the traditional model of banking?
No, one hasn't seen it, but I don't think that should, make us, lose our guard, or lower our guard. It's like what we keep talking about. पुराने जमाने में vacuum tubes होते थे, अपने रेडियो में vacuum tubes होते थे. I am like a vacuum tube. I can keep improving. I can keep adding some buttons here, improving the glass quality. But if I have not prepared for the transistors, it will happen fast and sudden.
Right. It'll be a binary shift, not
It's a binary shift. What are we banking on today? We're banking on A, trust, yeah, because that drives a lot of the liability piece, and B, a protection due to regulation. We're a regulated entity. Yeah, and there is an element of protection which happens out of that in the financial services. But both these paradigms can change very fast. Yeah, for a long time, for example, we'd say कि ये तो खाली payment कर रहा है ये fintech, he will never get customers. ठीक है भाई, he's taken, all my customers on the payments platform, but bulk of his money is still with us. But some of those are changing because they have trust builds up over a period of time. Yes, it doesn't change overnight, but you cannot say the same thing 3 years later. And all of us are very vigilant and careful about and worried to some extent about this piece. So the way banking gets done itself may be very different tomorrow, in 3 years' time, in 5 years' time.
Right.
And that's why back again, whether it is a disintegrated form or a very highly integrated tech form, who knows?
Right. So a couple of questions from our clients who are hungry for growth. As you can make out, the Marcellus client is like the IPL generation. उनको growth चाहिए. पुराना test match थोड़ा सा पासे है. So Rohan says that look, you're saying you've got the lowest cost to liabilities, yet HDFC Bank, which is 5 times bigger than you, is growing faster than you. So please help me understand that. And then Abhi Jain gives a helpful sort of hint. He's saying that IBC आ गया है, आप बोल रहे हो corporate stress कम हो गया है, and therefore surely the Indian promoter or the institutional safeguards have improved. Our promoters behaving more responsibly, and if I join the two up, lowest cost of funds, 1/5 the size of HDFC Bank, IBC, improved behavior on promoters. Is there a faster loan book growth ahead for Kotak in the years ahead?
Yeah. No, you see, again, this is something which I keep mentioning. I have money in my pocket doesn't mean that I will stand on Marine Drive and say, bhai, leke jao. Because that is activity one of a banker. It has to come back. Yeah. And how much ever I may want ki bhai, pura jeb ka paisa dal do, unless I'm conscious and cognizant of the risk, yeah, it is of no use. And repeatedly, once every 3 years, 5 years, you see, markets keep coming back and giving you that lesson all over again. It's not that we're scared of pressing the accelerator. Yeah, but it's not going to be an unbridled, bhai chalo, cost of fund come hai abhi, daba do. Because, ultimately, you must remember, the banking equation is a very funny equation. 2% kamana hai. Opportunity to lose is 100%. So, you have to be wrong 1 in 50 times for that equation to get into trouble. Yeah. So risk is an extremely important parameter. Yeah. And yes, I understand risk. And hence, while the foot on the accelerator is pressed, I have to have the second foot continuously ready. And, cost of fund is an opportunity to enter better quality. Yes. Yeah, because as you move, up the quality curve, the customer demands you a lower cost rate. So that there is always a good equation, but it doesn't mean unbridled growth. And again, from personal experience, I can tell you, the moment when growth starts veering above the 30%, and this is not overall, in segments, in sub-segments, it comes back and starts haunting you 2 to 3 years later. Yeah, because at the end of the day, there are processes, there are people, there is technology. When you grow beyond a certain amount, some of that does keep coming back at you. And of course, you got to correct it thereafter.
Right. Tej?
You've got multiple business lines, multiple businesses within Kotak, life insurance, general insurance, wealth, brokerage, even special situations. So out of all of these businesses, which do you think is the most promising one, or how do you think about allocating capital to each of these businesses looking forward?
Well, you are asking a parent by बताओ कौन सा child ज़्यादा पसंद वाला है. I see it's tough to do that choice, but sitting where we are at this point of time, the spectrum looks very interesting because you take a segment and in the marketplace, A, our share is very small. B, the market opportunity for growth is huge. You showed that graph, no? $2,000, and 100 billion incremental. You look at each and every segment. You look at life insurance, you look at general insurance, you look at brokerage. Take a segment, it is insignificant. You take unsecured personal loans. So I think it's very difficult to choose. Yeah. And hence, while Mr. Mukherjee says, declutter, isolate, focus, at this point of time, a lot of it looks good. So don't ask me to choose favorites, please. It's pretty much good. And the good news is the whole still makes a lot more sense than each individual part. Sorry, you asked the second one, which I missed, Page. There was a second part.
Was there a second question you asked?
No, this was the question.
Okay.
So Deepak, so we've got 4 minutes. Let's address the sort of the most topical question घर में across the world. कि 2-3 हफ्ते में inflation का upsurge आने वाला है. A lot of people apparently can see the future. They believe that as the COVID vaccinations sort of play out, economic activity will resume. There's all this $11-12 trillion ka fiscal and monetary stimulus inside the global economy. So stimulus powered customers with their COVID jabs will go berserk spending. Already semiconductor की shortage है, shipping container की shortage है. अब तो inflation आ जाएगा, फिर फेडरल रिजर्व रेट हाइक कर देगा, फिर RBI रेट हाइक कर देगा, और फिर उसके बाद तो बस story over है. Now, you guys, I'm sure, have a fairly, acute sense for risk. You just gave a lovely way to think about risk in banking. What do you make of this whole notion that higher inflation and higher interest rates means that the party will come to an end?
So, Uday had a very simple answer just a couple of days back, trying to talk of this inflation. He said, we've been hearing from 2008, 2009, the wolf is coming, the wolf is coming, the wolf is coming. Yeah. And then all economists have said, hey, this is the theoretical, logical way, so much liquidity, so much asset bubble. It must happen. It must happen. It's not happened now. Does it mean that it won't happen? No, it won't. It doesn't mean that. Does it mean that I must not have my, guards on? I must have my guards on. Yeah. But if I start looking, भाई inflation आएगा, फिर अभी से दुकान बंद कर दूं, भाई ये नहीं करूं, वो नहीं करूं, then I'm not in business. So yes, I must have my risk management on to think of an eventuality if suddenly inflation shoots up to 7-8% tomorrow. It's quite possible. Theoretically, it should have happened, yeah, or it must happen in the next 3 to 6 to 12 months. But it's such a complex equation today. It's not just dependent on 2 or 3 parameters. So the brighter and the optimistic way to look at it is, don't worry about it too much. Yeah, we're looking at a growth environment just now. Even if you look at a 10-12% GDP growth and 5% inflation hua ya 7% hua, you're talking of a 15-odd%, nominal growth going forward. And banking must be a multiple of that. Yeah, so be happy with that, prepare for that, but keep your risk. I mean, like I said, don't stand on Marine Drive and throw money. Yeah, be prepared for risks and keep evaluating those risks. But it's probably not at this point of time looking like an issue.
So thank you, Deepak. I think one of the main reasons we were so keen you speak to our client base and our audiences, we keep getting exhorted by people to invest in lenders, some bankers, some NBFCs who specialize in standing in Marine Drive and throwing out notes. Us being Darpok middle class folks, we obviously don't have the nerve to do that. But people don't sort of like listening from hearing it from us, and that's why when stalwarts like you explain, if you get it wrong, you lose 100%. You get it right, you make 2%. And I was thinking you can lose 100% with underlying debt equity of 10x. So
Then you're gone. It's bankrupt.
So
Question
our
is,
goal is to compound consistently for our clients with bankers who don't stand on Marine Drive, but instead sit in the office doing risk management, and also bankers who come on our calls with Marcellus clients. Thank you very much. We learned a lot, and thanks for all the
pleasure, and thank you, thank you, Saurabh, thank you, Tej, and thank you, everyone else. Yeah, bye. Have a good day.
Thanks, Deepak. Thank you very
much.
Bye, Deepak.
See you.
So, folks, now we move to the Q&A for clients with the Marcellus team. What I'll do is I'll ask Tej to kick off with the most frequently asked questions on Kings of Capital. Right? We've been now live since July, so we've obviously got a sense for what are the things most clients ask. So Tej will take us through the FAQs. As he does that, feel free to punch in more questions, and then this time I will take the questions and fire it at Tej, and he'll try his best to answer your queries and questions on Kings of Capital. We are managing now, I think, 350, 360 crores. You'll see the compounding in a minute, but over to you, Tej.
Yeah. So looking at most of the questions that we've got so far can be split into three or four broad headings. One is why invest in a portfolio which consists of only one sector, companies from only financial services. Why invest in a portfolio of companies will be far more volatile than other portfolios given that it's only financial services. What is the outcome of investing at a time like this when Nifty is near its all-time high or at an all-time high? And what is the impact of investing in lenders which have high price to book multiples? So we'll cover off these 3-4 questions in the coming few slides. The first question on why invest in a portfolio which consists of only banks, NBFCs, non-lending financials, that is only one sector. So what we did look at was over the past 20 years, if we only compare Bank Nifty with the Nifty. So this is no stock selection. This is a comparison of the two indices. We looked at the returns first. So returns, undoubtedly, the Bank Nifty over the past 20 years has given 23% on a one-year rolling basis versus 14% for the Nifty. So even at an index level, there is a big difference, 23% CAGR versus 14% CAGR, so a difference of 9% on a one-year rolling returns basis. Secondly, when we looked at the Sharpe ratios, because the biggest sort of argument against a portfolio of financial services is that it will be highly volatile. So we looked at Sharpe ratios for the two indices, and we saw that the Bank Nifty outperforms the Nifty by more than 60%. The Sharpe ratio for the Bank Nifty is 1.6 times that of the Nifty. And this is data over the past 20 years. This is a comparison of the two indices. Secondly, how many times has the Nifty delivered a negative return in a quarter? So we've seen that in 41% of cases, Nifty delivers a negative return in a quarter. This is data for the past 20 years. This is not a short period of time, versus 35% for the Bank Nifty. How many times has it been the case that in 3 consecutive quarters has the Nifty delivered a negative return? So this has been the case in 14% over the past 20 years versus only 5% for the Bank Nifty. So only 3 of the past 81 quarters has the Bank Nifty delivered a negative return versus in 11 cases for the Nifty. So 3 times higher probability for the Nifty to deliver a negative return in 3 consecutive quarters versus the Bank Nifty. So at an index level, we see that, first of all, the Sharpe ratio is 1.6 times higher for the Bank Nifty. Secondly, number of times you deliver a negative return is much lower for the Bank Nifty. And thirdly, even if we look at consecutive quarters of negative returns, it's occurred only 4 times in the past for the bank Nifty versus 11 times for the Nifty. So to even look at the recent 3, 4, 5 years, even if we look at the past 2 years when we saw ILFS, Yes Bank, COVID, DHFL, etc. Even during those 2.5 years, the bank Nifty has outperformed the Nifty. So when we talk about the recent 2, 3 years when we've seen COVID, maybe the past year is what colors our judgment, but the past 2 to 2.5 to 3 years, even during this time period, the bank Nifty as an index has outperformed the Nifty. Coming to the question on what is the sort of volatility for high quality lenders versus high quality non-financial companies. Now what we did was we looked at companies which had delivered consistent historical fundamentals, that is consistent return on capital employed of more than 15%, consistent growth of more than 10%, revenue growth of more than 10% for every year over the past 10 years. And we created 10 such portfolios starting from 2000 to 2010. For each of these portfolios, we also created a portfolio of such financial companies. That is loan book growth of more than 15% for each of the previous 10 years and ROE of more than 15% for each of the preceding 10 years. Now, for each of these 10 portfolios, what we observed was that every time in each and every case, the Sharpe ratio of the high quality lenders, of the high quality financial companies was higher than the Sharpe ratio of the high quality non-financial companies. So in 100% of cases, we saw higher Sharpe ratios. Even more surprisingly, what we saw was in 7 of the 11 portfolios, the standard deviation itself for the financial companies was lower than the non-financial companies. Therefore, when it comes to high quality lenders and high quality lenders, when we compare them to high quality non-financial companies, the volatility itself is lower. So for a Hdfc bank, for a Kotak bank, the volatility will be lower than most of the non-financial, high quality non-financial companies. And when we combine these two factors, first at an index level itself, you are at an advantage because your Sharpe ratio is higher. Second layer of higher outperformance, higher Sharpe ratios is that when you select high quality financial companies, you get an even higher Sharpe ratio than high quality non-financial companies. Moving forward on this notion of what happens if we invest when the Nifty is at an all-time high or the bank Nifty is at an all-time high, what we did was we took the case of a very unlucky investor who invests exactly when the Nifty hits an all-time high. So, and we took the 5 stocks which have been listed from Kings of Capital over the past 20 years. And every time the Nifty hits an all-time high, the investor invests in this 5-stock portfolio. And what we saw was that in more than 95% cases, in 98% cases, we saw that the 5-year return is more than 15%. In more than 70% cases, the 5-year return is more than 20%. So irrespective of when you invest, because the share price, because the earnings compounding, book value per share compounding is so strong, the share price keeps on compounding at more than 15%, more than 20%. And that makes the price to book multiple or the PE multiple almost redundant. Finally, coming to the impact of entry price to book multiples on your eventual returns. So we did an exercise where we saw that how much of share price returns of an investor can be attributable to entry price to book multiples. So what we found out was as long as you have a long time horizon, which is greater than say 3 years, 5 years, 7 years, less than 20% of your returns will be driven by change in price to book multiples. Over a period of time, say if we take a scenario of say 15-year time horizon, 95% of share price returns will be driven by book value per share compounding. And that is the essence of investing in high quality lenders. We need to focus on something which drives more than 85-90% of value, share price returns, and not the remaining 10, 15, 20%. This is the performance since inception. We've delivered about 32% since inception in the Kings of Capital portfolio. 60% of the portfolio consists of lenders, 40% consists of non-lenders. The lenders in our portfolio have delivered about 51% since inception. And we launched in July, so it's been about 7-8 months now. Current AUM stands at around 350-360 crores.
So, folks, I'll kick off with those questions on the underperformance, right? As you can see, the underperformance is a statistical thing. The Nifty Banks Index, by definition, is all banks. And as Tej is saying, our banks have also done, if you adjust for the cash drag, because remember, in 6 months, this portfolio is built up to 350 crores. So there's relentless flow of cash into the portfolio, which creates cash drag. Adjusting for that, our banks have more than kept up with the bank Nifty. So one of you, Parsh, is saying, why don't you use Nifty Financial Services? Parsh, Nifty Financial Services is also 90% lenders. So whether anybody likes it or not, whether we like it or not, there is no index in India which has 60% lenders, 40% non-lenders, and we don't have a problem with that. It's just that the regulator requires us to have a benchmark. We've given Bank Nifty as a benchmark. Honestly, if a client has a problem with 32% returns since 28 July, we would love not to have that client. Our goal is to consistently compound for our clients, and from the day we started Kings of Capital, I was investor number one. It's consistently compounding, and it's done exactly what it says on the tin. And you can also see, hopefully, after talking to Dipak Gupta today, you can also see why it's consistently compounding, right? We are invested in clean, high quality lenders with strong comparative advantages. Deepak Gupta explained that their cost of funds is now the lowest in the country, and were steadily growing their business. No drama, no adventure. We lock ourselves into such companies, and we compound that at good rates. If anybody has a problem with 32% compounding in 6 months, this is raw compounding, folks. This is not annualized, right? If you have a problem with 32% compounding, please don't come to Marcellus. Now let's focus on stocks. So there's a question on Aavas stage. One client just lost it in the list of questions. I forget the name. I'll see. Yeah, Amit Khanna is asking. He said that Deepak ji just said retail business is in distress. You have Aavas in the portfolio. How do you justify that?
Yeah. So Aavas, if we link back our discussion, if we go back to the discussion with Mr. Dipak Gupta, it's on the secured side of retail. 100% of Aavas's loan book is secured. They do granular, small ticket size housing loans in tier 3, tier 4 sort of cities in India. Average ticket size of around 8-9 lakh rupees. And Aavas has been doing this first as a subsidiary of AU. They started off as a subsidiary of AU, then AU became a bank, and therefore they had to sell off their stake to the private equity players who own Aavas now. And in housing finance, like even Dipak Gupta was mentioning, currently there is a strong resurgence of demand. There is more than enough demand in housing finance, and there are not many players who are able to cater to that demand, because most of the housing finance companies of the past 5 years suffered massively. Aavas, on the other hand, over the past 5 years has had enough liquidity, has never borrowed money in the CP market, has a tier 1 capital of more than 50%, and it does not do developer loans. It does not do high ticket 50 lakh 1 crore rupee ticket size sort of loans. What it does is it lends directly to people who are building their own home. It does not lend to people it does not lend to properties which are under construction even. And it lends to these people directly in tier 3, tier 4 cities at 12, 13, 14%. When its cost of funds is around 7-8%. So it's making 5% spreads because of its ability to underwrite credit in rural areas where most banks and NBFCs are not able to underwrite this sort of credit, and it is able to do so because of its links to AU Small Finance Bank, which also follows a similar business model of lending to the self-employed by assessing credit on the basis of cash flow rather than any other formal income proof. And therefore, it has historically been able to maintain asset quality, gross NPAs of under 1%.
Okay, so there's a question on, do you have a small mid cap? So anonymous attendee asks, can you let us know if you have any small cap or mid cap lenders amongst your 8 lenders, and how do you select amongst non-market leaders amongst these small caps?
Right. Yes, so we do have, like we discussed, Aavas. We do have a couple of other smaller banks, one small bank, one small NBFC. And the process of selecting these lenders is simple. That the process is what we've illustrated in the past as well. First of all, we eliminate companies which have poor accounting quality. We run all of these banks and NBFCs through our forensic filter. We have a set of 11 accounting ratios specifically designed for banks and NBFCs. About a third, about 35 to 40% of the 100 stocks in our universe get eliminated by way of our forensic filter itself. The next level of filtering is whether these banks and NBFCs have historically been able to generate return on capital employed or return on equity above cost of equity or not. That is the second level of filter. Again, about 30-35 companies get eliminated at this stage of the filtering process. And then we are left with about 25-30 companies where we try and assess what is the sort of competitive advantage that these companies have, and what has been the reason behind the consistently high returns on equity. So all banks or NBFCs that we have consistently have, first of all, tier 1 above 15-16% and decent returns on equity above 15-16% historically.
So Anjal Gupta asks a question: if most of the stocks in this portfolio is public information, could you please comment what advantage we as investors get by taking help of Marcellus?
Yeah. So there are two, three aspects to this. One is the position sizing. So apart from stock selection, position sizing itself is what leads to returns which can be pretty different even with the same set of stocks. So if we would have held a portfolio of which would have an equal weights across all our stocks, especially in Kings of Capital. So across our 12 stocks, we have one stock which is at 15-16% in the portfolio, and we have one stock which is at 3.5-4% in the portfolio. And that sort of divergence would eventually result in very different results if you were to build a portfolio of the same 12-13 stocks with either equal weights or weights which you would assign to the stocks on your own. So one is position sizing. The other is there will always be elements of risk lurking. For example, how do you think about succession planning at most of these companies? How do you think about the impact of succession planning at, say, Hdfc Bank? And how do we keep on adjusting for that in our portfolios, either by way of position sizing or maybe by way of completely exiting or entering new stocks? So, for example, we had one stock which we exited from the portfolio in the past 7-8 months. Now, how do we take that call of exiting DCB Bank, and which new stock do we get into the portfolio? So these are the calls which will lead to eventually different sort of outcomes, even in share price performance over a period of time.
So folks, Tej is too modest to say this himself, so I'll say it on his behalf. So just to give you a sense of how powerful position sizing is, so back in 1st April, so early April 2020, Bajaj Finance was, I remember, around 3% of the CCP portfolio, consistent combined portfolio. Remember, KCP only started in July. So back in April 2020, with the COVID panic on at full throttle, Bajaj Finance had corrected by 70%, and it was at 3% of our portfolio. Tej led the effort, which led the team to conclude that Bajaj Finance on 15th April 2020 is an even stronger franchise than it was on 1st January 2020. And therefore, by late April, we told our trader to triple our position in Bajaj Finance, right? And those of you who are CCP clients would have made a lot of money on the back of that call to triple Bajaj Finance. So that sort of work, right, where the rest of the country is panicking, saying Bajaj Finance khatam hai, becho, this broker, that broker is putting sell call, right? To do the research, to keep, to stay calm, execute, triple the position, thande dimag se. That's the skill that we bring to the table. These stocks that we hold, the reason we make them public is these are well-known stocks anyway. If somebody did a little bit of work, they would find out anyway Marcellus holds it. We are happy to therefore talk about what we hold. We're happy to tell you why we do it. What we don't disclose to the public is not only the position size at a point in time, we also don't disclose where are we ramping up, where are we ramping down, and through that ramp up, ramp down, through position sizing, we make a lot of money for our clients, and we hope to continue doing that for many years to come. Let's move to another subject, which is, I think, very appropriate, very relevant for people like us. Abhi Jain asks about how do you deal with key man risk, right? You're investing in companies where one or two people are very central to that franchise. What happens to that? What happens if that person dies? How does Marcellus deal with that?
Yeah. So to give some more insight on the way we, first of all, stock selection is what we explained. To give some more insight on how we adjust for or how we position size basis, key man risk, succession planning, and also what the company is doing on a continuous ongoing basis. So one part is getting the stock into the portfolio. And then the second part is whether the company is doing enough on an ongoing basis to keep up its competitive advantage and to keep competition out, and therefore able is the company in the future as well going to sustainably generate returns on equity well above cost of equity. So across all stocks in our portfolio and across all portfolios of Marcellus, we have a couple of frameworks to decipher whether a company is well positioned for succession planning, whether a company is doing enough to maintain its competitive edge, to maintain its competitive advantage on an ongoing basis or not. Now, the way we look at succession planning is there are three factors on which we score companies on succession planning. One is how strong and how independent is the board. Are there people who are related to the promoter or people who are related to the CEO and the management of the board? Or is the board truly independent, has people from diverse fields who can help the management team give an independent point of view and help them with the business? Second is, since how long have most of the key men, says the CFO, the COO, most of the people who've been with the company for a long period of time and are in prominent positions, how long have they been with the company? Does the company have to recruit people from outside the organization on a regular basis, or have they been elevated from within the company? And finally, third is, what is the sort of decentralization and what sort of processes are in place at the company? So basis these three factors, we try and assess what is the risk of succession planning at a company, and how do we position size that company in our portfolio.
So there's a couple of housekeeping questions I'll quickly address. So Anurag Shukla asks, lately you have trimmed Bajaj from my CCP but left it untouched in my KCP. Any reason? Simple reason, Anurag ji, we are adding a stock in your CCP. We are adding a dhamakedar monopolist in your CCP portfolio. I suspect Rakshit will talk about it in the webinar he does he does in next month, where he'll explain to you which monopolist is being added to your CCP portfolio. And to make space for that, we had to reduce your Bajaj by a little bit. We have had no change in our conviction on Bajaj, and therefore it continues to be in all our portfolios. Shankar Brahma asks, is Marcellus looking at a mid-small cap PMS in the near term? I'm sorry, Shankar, no, the answer is we're not going to be launching any mid-small cap PMSs in the coming fiscal. We might reopen Little Champs to some flows in 2022, perhaps some stage middle of the year 2022, late 2022. We might open Little Champs for a fresh infusion of flows, but no plans for small mid-cap PMS in the coming fiscal. Right. Let's move to another subject, which is I think very interesting. So Neerav Hemani asks, will you be keen to add positions stage in exchanges, registrars, custodians to play the savings angle?
We've looked at some of the custodians. We've looked at some of the market infrastructure plays in the past, and when we are building the portfolio as well, and we continue to look at them. But the challenge with most of them is that the competitive edge or the competitive advantage that they have is given by either the government or the regulator, and that at any given point of time can be taken away by the regulator. So for the regulator to allow these companies to consistently make 25% return on equity or 30% return on capital employed, will be very difficult. As soon as the regulator or the government sees that they are making return on capital employed or return on equity above cost of capital, there will be some either regulatory change or there will be a new player which will come in, and that will again come down to cost of capital. Therefore, we are a bit hesitant on adding any of these market infrastructure plays to the portfolio.
So Tej, there's quite an interesting idea SPS Chauhan has suggested. He's saying, perhaps she's saying, apologies, it's difficult for me to make out the gender. SPS Chauhan is saying, can you not split and show the percentage growth for lenders and non-lenders? So I suspect what they're referring to is, when we show performance, can we not show lenders so that this whole notion that KCP ने कुछ underperform कर दिया है, that notion can be dealt with. We're not that fussed about what people think of our performance at many levels, but it's a neat idea. Anything which gives clients more visibility, more transparency, we'll think about it. So thank you for that, SPS John. That's a neat idea. We'll think about it. Jayan Sadrangani asks, for those who have not entered the KCB portfolio, is it a tad too late to enter now?
Yeah, I'll share the slides just a second. Yeah, so if you look at this slide, what we have shown over here is irrespective of the price to book multiple you enter at, irrespective of the PE multiple you enter at, more than 80% of share price returns over the next 5 years, 10 years, or 15 years will be driven by book value per share compounding. So as long as we are convinced of the fact that Hdfc Bank, Kotak Bank, Bajaj Finance, etc., they'll keep on growing at 20-25%. Say Bajaj Finance has a 1.5% market share or a Kotak Bank has a 1.5% market share. Will they go to 3%, 4% market share or not? That is the only question that needs to be thought about, irrespective of what the price to book multiple is. As long as you have a longer time horizon, you'll have share price performance which will be similar to your book value per share compounding. So let's assume that over the next 5 years, book value per share compounding for these companies is 20%. In case you would have entered before COVID, or say in March, April, May, your share price compounding would have been 21-22%. If you enter now, maybe it will be 18-19%, or it might be 20-21%. But the impact of entry price to book multiples is not significant over a long period of time.
So Jayant, it's not too late, whether it's CCP, KCP. We have consistently helped clients understand, demonstrated that there is no right or wrong time to enter great franchises. If you haven't invested in KCP, reach out to the Marcellus representative, or if you're coming via wealth manager, reach out to the wealth manager. As Dipak Gupta, no less, explained, we are in the early stages of what looks like an economic recovery. And whilst we can all sit here worrying about inflation, second wave, third wave, if you want to participate in the economic recovery, this is a good time to invest, leaving aside whatever happens to macro. As Tej explained right at the outset, there are 3 layers of upside that we get to play over the next 2, 3, 4 years. The first is the improvement in improvement in credit quality as the COVID scare abates. Economy normalizes, credit quality improves, all of us will benefit from that. The earnings, the profits of these lenders will benefit from that. Secondly, we benefit from the improvement in credit growth, right? Dipak Gupta explained that in sectors like housing finance, there's much less competition now for the champion lenders than there was 2, 3 years ago, 4 years ago. Many of the housing finance companies who were posing competition 2, 3 years ago have flamed out, and therefore for well-run lenders there's plenty of opportunity. And the third layer is the PE multiple normalizing from that massive scare that the lending sector received last year. So you're playing 3 layers of upside, and therefore it's not too late to enter the KCP portfolio. There's one last question and we'll then draw things to a close. Anurag Shukla says, with unsecured retail under stress, where does that leave Bajaj Finance stage?
Yeah, sure. So Bajaj Finance right now has about 26% tier 1. This is after providing for very aggressively. At the beginning of COVID itself, last March itself, they said that they'll provide for about 6 to 7% of their loan book. They've already provided for 4-5%. The remaining 1.5% will come through in the last quarter. Despite all of this, their return on equity for this year has been 13-14%. And this is a year with COVID. Now, next year, they'll go back to 20% plus return on equity. And this is assuming that whatever they provided for is going to be completely written off. They've themselves provided for aggressively in their assessment, and what has come about of their unsecured loan book is much better than most of the estimates that were made in March, April, May last year. Secondly, when we look at their loan book, about 55 to 60% is not unsecured. There is this policy that Bajaj Finance runs a completely unsecured loan book. About 35% of it is housing finance. More than a third of their loan book is housing finance. About 10 to 15% is auto loans, which is lending to the Bajaj Auto customers. And then there is 10, 15, 20%, which is SME and other sorts of secured lending. So less than half of their loan book is unsecured. And even on that, they've aggressively provided for. Despite this aggressive provision, they're at more than 25% Tier 1, very well positioned for the sort of growth that will come about. And especially in the unsecured space, because most lenders have seen that what's happened through COVID in the unsecured lending space has completely damaged their loan book. Most of them are exiting or have already exited this space. That leaves the ground wide open for Bajaj Finance to accelerate.
So I'll take one last question and then we'll draw the curtain on today's show. So Altaf Tapiaji says that, look, I've already invested in CCP. If I invest in KCP, won't I just be duplicating the portfolio? No, sir, you won't be. There's only a 4-stock overlap between CCP and KCP. The four CCP financial services stocks are also in Kings of Capital. Kings of Capital has a further 8 stocks which are not part of consistent compounders, and therefore you get a completely new type of compounding driven on the back of lending, insurance, asset management, and wealth management in our country. So thank you, folks. Thank you for your questions. Thank you for joining us today as we spoke to one of the doyens of Indian banking, Dipak Gupta. Thanks a lot. Bye for now. Thanks, Tej.
Thank you.
Thanks, Gaurav. Thanks, Nitesh.